Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Ananth Narayan, Professor Finance, SPJMIR, joining in. Welcome to the show, Ananth, and always a pleasure to speak to you and get great insights from you. Ananth, my first question coming to you is, everyone right now is talking about how inflation is going to pan out as well. We just had the recent CPI inflation, which came in at 6.3%, core inflation at 6.16%, and this is for the month of June. Now, clearly it remains above the RBI 6% target. Do you think it will be largely looked through unless it persists above 6% for an extended period of time?
I think so, Hiral. Look, last week, in fact, the governor gave an interview at Business Standard. I think he was very clear there that he is going to be focused on growth, and rightly so. A few things going along, with that. The fact is, even globally, yields really haven't gone up so much, despite the fact that there is a worry about global inflation. Likewise, central banks globally are in, of course, a few of them like Brazil, etc., are reacting right now. But otherwise, by and large, nobody's in a hurry really to normalize monetary policy as such. So the global context remains largely benign. And given that we have lots of foreign currency reserves at this point in time, that allows us to gives us a lot of policy space in that sense. Second, Hiral, while inflation is a problem and it is going to be a medium-term problem for us, it's not very clear that monetary policy can address this kind of inflation. Our credit offtake is less than 6% at this point in time. Right. Normally, you can control inflation if there is rapid credit growth happening, therefore a lot of demand being generated in the economy. That's not the case at all. So it's not even clear that a rapid rise in interest rates in India will address the core problem of inflation as such. And as I mentioned, when credit offtake is less than 6%, it's probably the right thing to do. So I think for now, the MPC and the RBI, while there'll be a lot of debate and probably even some dissent in the decision, I think they will veer towards giving growth a chance for now. But the medium-term problem of inflation, of growth, of jobs, etc., will remain. They won't go away. But for now, I think they will remain accommodative for a longer time.
So is it right to say that the RBI will continue to retain its growth supportive stance at least through calendar year 21?
I think so. So towards the end of this year, and God forbid if we don't have a third wave and all that kind of nonsense, towards the end of this year, you might see some normalization, which is liquidity, excesses being withdrawn, maybe the short end rates being allowed to come within the corridor of 3.35% and 4% that it is currently. So small tinkering as far as short-term liquidity and rates are concerned might happen. But otherwise, I don't see any policy change for this fiscal year. In fact, going through, I don't think there'll be any requirement to hike interest rates at this point in time.
Right. And what's your sense that you pick up with regards to where growth is concerned? Because taking into consideration that FY20 was a lower base, again, expectations had risen that probably we could see double-digit growth. However, the RBI also went ahead and cut their forecast. Taking the second wave into consideration, probability of a third wave that could come in, how do you see growth panning out?
It's a great question, Hiral. So look, I think it makes sense to look at growth over a 2-year period, given that, last year was a washout year. Comparing against last year doesn't make really too much of sense. You should be comparing strictly against 2 years ago. Now, if I look at a 2-year period, it does feel like we will struggle to get back to the level we were at in FY20, which is given that May and June have been somewhat, April, May and June have been somewhat soft. But here is the good news, Hiral, and which is what is going to be confusing. The formal economy is doing well. Look at the FY21 results for all the companies which are listed. Of course, sectors have done badly. Hospitality, transport, the contact services base, they've obviously done badly. But nevertheless, overall companies listed on stock exchanges, they've not had such a fantastic run as far as earnings is concerned for a long, long time, right? So CMI tracks data for some 4,000 odd, 3,000 odd companies. Sales is down, but profits, the profits before interest and tax and depreciation is up like some 25%. So the formal sector is doing extremely well, and this is not small. This is a big chunk of the economy. Right. The informal sector equally is doing badly. So if you look at the unemployment data coming out from the same CMIE, that tells you that jobs are actually down. That actually, that report that Azim Premji came out with on the nature of working in India, state of working in India, that showed that actual incomes at the hands of workers has come down by something like 17% last year. And this is even before the second wave hit us. So, clearly there is an informal economy of small, micro, medium enterprises, mom and pop shops, which are going through trouble, and the formal economy is doing very well. Now, mind you, GDP is measured largely using formal economy.
Correct.
A lot of that data which is used, including by the annual survey of industries, is of the larger companies, larger factories. The micro enterprises, there's supposed to be 6.3 crore of them, are not really measured that well when it comes to GDP. So headline GDP might show a double-digit growth. It might show 10.5% growth, but that might overstate the real state of the economy. If you really took the overall economy, including the informal sector, even last year was probably not minus 7.3. It was probably minus 10, minus 11%. And likewise this year again might be maybe 8.5% growth or so, not really 10.5%.
Right. So with this, as you mentioned that, yes, the unorganized space is actually the one which is ruling under pressure. With this, the overall rural activity is something that we were talking about probably in the first few months, where we said that, yes, it's the rural economy which is going to support us. However, the second wave has not really left rural India behind. Do you think rural activity is still resilient enough?
Again, great question, Hiral. And I think it's going to be softer than it was after the first round, right? After the first round of COVID, the rural sector was actually doing reasonably well. As you said, COVID didn't impact them that much. So even services and manufacturing in the rural sector was somewhat preserved. Plus, you had a lot of benefits being pumped in by the government, including Prime Minister's Kisan Yojana, including the Food Corporation of India doing a lot of procurement, and of course, things like Narega. So there was a certain amount of resilience to the core rural economy. So the economy which was already rural, not the migrant workers who went back, but the core rural economy did reasonably well. And you saw that, in your FMCG products, your tractor sales, even your two-wheeler sales, etc., were largely doing better in the semi-urban and the rural areas as compared to the urban areas. That was the first wave. Second wave, it does feel that the impact on rural India, particularly in the hinterland, has been quite intense. Now, we are also seeing signs that there might be a sharp recovery. So, I know it's not strictly rural India, but, look at Indians holidaying right now in Manali and wherever. So it does feel like activity is slowly coming back. But I think rural India will be a bit of not as robust and as resilient as it was the first wave. To that extent, yes, there might be some pressure on the revival. Nevertheless, there are strong signs, Hiral, that the formal economy continues to do well. So this is a case where the terms of trade have shifted towards the formal economy at the cost of the unorganized and the small businesses.
Okay. And with all of this, if you see in terms of where India is concerned, overall, in terms of the 22 budget as well, we had cut our allocations to the rural sector, as we mentioned about the different schemes as well. Do you think allocations will have to be increased further? Revisions will have to be made? And if that happens, will it actually put pressure on our balance sheet?
So yes to everything, Hiral. Allocations have to go up. It will put pressure on our balance sheet, but I don't think we have a choice. We'll have to do a lot of spending. Look, I think there are various reasons why spending has to go up. One is if the economy as a whole is depressed, you do need the government to do a counter-cyclical spending at this point in time. You have to give, when the engine is dead, you have to rev the engine with something. So the government spending is the best way of doing that. Second, if there are people who are going through deep distress, and there are signs that people have to pawn their gold, have had to take loans to, take care of their loved ones. If there is deep distress, one, the government is taking care of food security, but alongside that, there might be more required. So more handouts might be required to those who are in the bottom of the pyramid, who have lost jobs, who don't have any other access right at this point in time, purely for survival perspective. Third thing is, eventually a country like ours requires investment. You need money going into capital formation so that our output goes up and so that our jobs gets addressed. Over the last 15 years, Hiral, we have done a terrible job of creating enough jobs for our aspirational young people. That is something which needs to be addressed. So Atmanirbhar Bharat has to work. Okay, we don't have a choice. Now, all of that requires investment, whether it is physical infrastructure like power, like roads, like deep sea ports, like attracting companies to set up manufacturing plants, etc. in India. All of that requires investments. Plus things like even deeper things like education, healthcare, and nutrition, and water and sanitation. These are basic public services which are required as investments so that our people can eventually get jobs and output, right, and create output. So all of this requires government spending. And at this point of time, for the government to not spend would be a bad idea. And I'm supposed to be a fiscal hawk. I normally fight for keeping the fiscal well balanced. I'm saying it makes sense to spend at this point in time. Now, of course, this creates a problem in terms of the government having to fund a larger deficit. Already the debt to GDP is over 90% of GDP right now, Hiral. But here is the way out. If the investments that we're putting in right now will generate a return in terms of higher taxes for the government eventually, at a rate higher than the cost to the government. It's a basic corporate finance. Yeah. If your cost of funds is 6.5%, as long as your return is going to be higher than that, you can still survive. And that's what we have to do. And will we get a nominal growth of more than 7-8%? Of course we will. I mean, we are definitely capable of 10% nominal growth. So if with that faith, I think it makes sense for the government to not worry about the deficit so much now, even if it means monetization. Anyway, we're monetize a little bit more, and put money into both survival as well as revival and investment. Very, very required for us to reach our aspirations as far as an economy is concerned.
Right. So with this, as you mentioned about the debt to GDP ratio as well, it's rising to historic highs. How big a concern is sovereign exposure going to be for the banks?
For the banks, not particularly high as a credit exposure, Hiral, because clearly all the debt is in rupees, right? So the one good thing we have done as a country is all our debt is largely in rupees. It's about 5%, I think, is the foreign currency debt, which is nothing, which we can easily live with. This includes the FPI investments as well. So it's nothing. So the problem, of course, is a duration risk. The fact is that a lot of 10-year bonds are sitting on bank books. If interest rates were to rise dramatically, then they could be sitting on a loss. Now, there are a couple of things that are at play. One is RBI has given dispensation to the banks not to count the mark-to-market losses on these kind of investments. So the held to maturity category of bonds, as we call it, has been increased quite dramatically, right? So there is some leeway available there. And chances are, if ever there's pressure because yields are going up, the RBI will give more dispensation on that held to maturity. So that should not be an immediate problem. The second thing is, it is likely that interest rates will be kept low for a while. I think for the next 2-3 years, we don't have to worry. The problem could be after 2-3 years, if we don't get our act together, if we don't create jobs and output, if we go through the same 2009-2013 circus of high inflation, followed by high imports, followed by not enough jobs, followed by not enough domestic output, and it becomes a vicious cycle, that's when we could have a problem. So we have 2-3 years even now to set things right, clean up our banking mess, clean up our, create that Atmanirbhar Bharat and jobs and output. If we do all of that, we won't have any problem, including on the yield side. The inflation can be kept under control.
Right. So with all of this now, if you have to look at the liquidity side of it, especially in terms of where US and Europe go, US, we're thinking of that probably they will start squeezing it out. If all of this happens, how is it going to affect markets like India?
Right. So two quick points there, Hiral. One is, look, I think the tide in the global context is slightly turning at this point in time. About a month back, we were all worried about runaway inflation, runaway growth in the US, and it's still very, very high. In fact, today is an inflation print in the US. CPI print is going to come out. It will be a high number. We were worried about it. But since then, the fact that bond yields have come down the way they have, despite the FOMC suggesting that they will eventually hike rates by 2023, etc., tells you that there is still space available globally as far as monetary policy is concerned. And US is the hottest part of the economy right now, right? Europe is slightly cooler, Japan is cooler. China has in fact cut RRR rates just over the weekend on Friday. So the point is, globally as well, it's no longer as much a worry about runaway growth, high inflation, and therefore the need to taper as much as it was a month ago. On the contrary, with the problems of the Delta variant of the virus creating issues globally, there are more concerns about, what could be, and what we were discussing before the show started about, this could be a recurring issue which goes on for a few more quarters, not just, something which we wish away after this year. So it's a lot more somber, the mood globally. So it gives us some breathing space in that sense. Having said that, eventually it does feel like this, immense amount of monetary accommodation which has happened has to be reversed, which means we will have to go through a kind of a taper at some point in time. It might not be led by the US, it might be led by Europe this time around. But nevertheless, some kind of a taper will happen, which is why I'm saying, assuming that's 2 or 3 years away, that entire taper, withdrawal of liquidity and, fighting against inflation or whatever it is, that gives us an ample opportunity and window, along with our very, very high foreign currency reserves, to set things right. Okay. If you had a global context where inflation was running away completely and people are doing taper right away, and we didn't have the FX reserves right now, frankly, RBI would be caught in the bind. It would have no choice but to hike interest rates to maintain financial stability. Thankfully, that's not the case. We can keep interest rates low. We can support the fiscal spending. The government can also increase its spending, increase its deficit without having to worry about an immediate blow up. But it has to get these basics right in the next 2-3 years. If it doesn't, then maybe in 2025, we could be looking at a repeat of 2013, of things blowing up at the same time.
Right. So overall, how do you see the rupee and the bond yields moving in India then?
So Hiral, one of the problems with bonds and rupee in India is that it's largely under the control of RBI. So any bet you take on bonds and rupee is a bet on what RBI will do. Never a happy situation. You ask any trader who's been in currency and bond markets, you don't want to bet purely basis what the RBI will do. Nevertheless, I'll answer your question. Look, I think because, as I mentioned repeatedly, because we have $610 billion of foreign currency reserves,
correct,
we still have forward purchase of dollars, which means actually $650 billion of foreign currency reserve. And because the global context is somewhat benign, with no large central bank showing urgency to normalize monetary policy, things are still looking okay globally. From that perspective, I think the RBI has immense ability to control yields at this point in time. While we are all programmed to think that once inflation shoots up, our interest rates have to go up because of a monetary policy framework, and therefore yields have to go up. I would not underestimate RBI's ability to hold interest rates, given the global context and given the fact that credit offtake is still not high in India. So in the short 1 to 2 year time, I think bond yields could surprise by not going up as much as we think it should. Okay, we will keep saying, people like me will keep saying bond yield should be at 7%, but the market will ignore that because RBI can do it. RBI can hold yields at a lower rate. But 2 years later, I'd be worried, because you have space because of foreign currency reserves and a benign global climate that might not last. If things remain as they are and if we don't sort out the issues, our imports will shoot up dramatically because we're not producing enough. Therefore, our current account deficit will again become a problem in 2 years' time. Our reserves will suddenly come down again. And if that time you have a taper tantrum as well, suddenly your yields will have to go up. So point being that for 2 years, I wouldn't be surprised if interest rates are kept under control. I don't know how it will be after 2 years. My fear is that there'll be a blow up in interest rates eventually after that, unless we get a few things right, including getting our domestic jobs and output position right. The same funda applies to the rupee as well. Plenty of reserves, RBI can do whatever it wants to. So the biggest outflow we've seen in a single year where RBI has had to sell dollars was $51 billion. Okay. I'm saying even if double the amount goes off in a single year, from $650 billion of reserves, you come down to $550 billion. It's not the end of the world. I mean, RBI has plenty of firepower available right now to control the currency, even if you have a large outflow. And remember, for this year, we're not even talking about outflow. We are talking about a balance of payment surplus. Even with the current account deficit coming back, because you have FDI, because you probably will get some FPI as well, it's still you're looking at a small balance of payment surplus. So RBI's ability to control FX is quite high. Given that, I think rupee will probably depreciate gently. So it will not strengthen too much. It will depreciate gently, but it will be very gentle depreciation. Right. But again, I don't know how it will be in 2 years' time.
2 years, right? So that's something.
If we don't get it right, if we don't get it right, if we don't set our shops right, and we continue with just printing money without creating jobs and output, frankly, then Rupee could be in for a blowout after 2 years.
Right, so that's something we need to watch out for as well. And then moving to the banking space right now, clearly, a credit growth is not really encouraging. We still need some more on that front. What would your view be with regards to credit growth is concerned? Because clearly the bank credit to the private sector has also declined for a second consecutive year in FY21, as well as consumer credit is seeing a decline.
Right. So Hiral, credit is unfortunately a problem on both sides here. One is, of course, because of your capacity utilization has been pretty low overall. I'm not talking about specifics. The need for companies to borrow has come down. There is no investments really happening to speak of, private sector investments, right? So the demand side, ability and willingness has come down in that sense, right? For credit. On the contrary, many companies which can borrow, a Reliance, for instance, has been deleveraging. They've been raising a lot of equity, right? And therefore reducing the need for debt. A lot of other companies have been following suit as well. So the point is, on the demand side, good quality borrowers needing money doesn't exist as much, right? You could still have some stress sectors in the hospitality sectors which need money, or real estate guys who need money, but there's a question of whether they have the ability to pay back or not. So, so good quality borrowers, maybe not so much available at this point in time. Likewise, on the supply side, yes, there are some good banks doing extremely well, including in State Bank of India, including some large private sector banks. But by and large, there's still a lot of overhang of non-performing assets and the history of the experiences we've had with bad lending over the last 10 years, because of which the ability and willingness of banks and NBFCs to lend at this point in time is also weak, right? So both in terms of demand and in supply, there is a bit of weakness right now. It can be addressed. Now, we will hopefully get some announcements soon, Hiral, both in terms of the bad bank and in terms of privatization of banks. Hopefully that will rejuvenate the financial sector. Plus, if the things we talked about of government doing some investments, spending some money and therefore reviving demand and consumption and savings and investments, then the credit cycle could take up again. But at the moment, it looks like it could remain subdued for a while. And frankly, the first sign of durable growth will be when credit offtake picks up from where it is right now.
Right. And very lastly, Ananth, with regards to the asset quality of the banks as well, how do you think that is expected to look like in the second half of FY22, taking into consideration the moratoriums, the restructurings that have happened? Do you think corporate asset quality, or even for that matter, retail and the MSME portfolio, will have to be, really monitored well, and there could be slippages on that front?
So Hiral, first of all, I'm really happy with the last financial stability report which came out from the RBI. It indicates things are not that bad. Frankly, in the beginning of the pandemic, I was really worried that we could be staring at 18% gross NPAs, etc. Right? I was completely wrong, and thank God for that. Now the RBI itself says 9.8% to 11.8%, or whatever was the financial stability number. Of course, you have to add a few numbers there. One is that we still have forbearance as far as MSME is concerned. We still have forbearance as far as some real estate is concerned. Plus, the banks have done a lot of write-offs here. So, over the last 5 years, they've written off something like 10 lakh crores there. So it doesn't show up as gross NPA, but nevertheless, they've gone through the pain, right? So the numbers are large, but at least a lot less large than what I thought it could be. Having said that, I think it goes back to what we discussed earlier. The formal sector is doing well, because which, barring the known problems like your telecom, your real estate, your airline and shipping, your power, these are known issues for which banks hopefully have already provisioned. There are no fresh infra surprises which have come up, right? Because the formal sector seems to be doing well. In fact, they're deleveraging right now. So industry and therefore the wholesale side seems to be under control, or no real shocks there. Where the problem, as you rightly mentioned, is we don't know enough about MSMEs and about the retail side, particularly the self-employed retail, right? We don't know how that is going. Now, I'm guessing there are worries there. I'm guessing that particularly the micro and the small, the mudra loans, the micro, etc., and the renewals which have happened in the recent past, there could be some issues on that front. Even there, though, from a banking sector perspective, I'm hoping look, unfortunately, much of the informal sector does not bank, or does not take credit, at least. They don't take loans from the banking system. So where the pain is hopefully not an exposure for the banking system. as much. It's probably with money lenders and local, borrowers, etc. So there would be pain in MSMEs and in the retail, particularly the self-employed, and it definitely has to be watched. But indications are it will not be as bad as I had feared, let's say 12 months or 14 months ago, as bad it could be. So, yeah, it's not going to create a massive pressure on the banking system. I think they're well capitalized right now, and therefore we can come through this okay. But remember, Hiral, the point is not that the banking system should survive. Eventually, we want them to run a marathon, right, and thrive. It's not enough if they say I'm okay, I'm going to survive. You need 15-16% credit growth.
Absolutely.
I don't think we are anywhere close to a state where the financial system as a whole can grow credit at 15, 16, 17%. There's a lot of changes which need to happen for that, including a one-time cleanup, including maybe privatization or making the banking system more efficient, a bad bank to cleanse some of the old stuff which is still lying around. So hopefully all of that will happen over the next few months and maybe even weeks as we speak. But yes, a lot to watch out for. I think getting the banking system right is critical to us getting our mojo back as far as the economy is concerned.
Absolutely. So all in all, Ananth, good to say, right to say that at least for the time being, we are in a pretty good place, not that much to worry about. But how the next 1.5 years pans out is something which is going to be crucial from a longer term perspective for the economy.
The way I would put it, Hiral, is that we are seeing two sides to the economy. Formal side is doing well. Of course, within the formal side, the hospitality sector isn't doing great, but I'm sure they will revive as well. There is a lot of pain in the informal economy, and I think we all recognize that. Okay, so both are equally true. One side doing very well, one side doing not well.
Yeah.
The good news, as you put it, is we have time to sort things out.
Correct.
It's not like we have a global gun on our head because of inflation, because of taper tantrum or whatever that we're going to blow up right now. Nothing like that is going to happen. We are not going to blow up. We have 2 years to set our shop in order. We have the time to clean our banking system and our financial services ecosystem so that it's capable of funding our growth aspirations. We have time to sort out the mess in many of our chronic stresses, your power, real estate, telecom, airline shipping, that MSME that we mentioned, you have to clean that up. Third, we have time to create jobs and output under that Atmanirbhar Bharat. It has to work. Eventually, Hiral, that's the bottom line. We've got to get jobs and output. We've got to do what China did, which is essentially start to produce and give jobs to people.
Right.
Once that happens, then everything else will fall in place. Inflation will fall in place, growth will fall in place, fiscal deficit will fall in place, everything will fall in place.
Right.
But we have a couple of years to achieve that. Hopefully, we will progress on the right path. If we don't get it right in 3 years' time, we could be looking at a crisis.
Absolutely. I think that's something we need to watch out for. Thank you, Ananth, so much for joining us on the show. Always a pleasure to speak to you. Thank you. Stay safe and speak to you soon again.
You too, Hiral. All the best. Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.